Let's talk to Marc Ostwald. He's a strategist at ADMISI. Very good morning to you, Marc. Right, I read with interest top market risks this year, and I'd like a line on each of these in terms of your risk parameters. US inflation moves higher.
It's certainly going to move higher because a lot of that is due to base effects. We had some surprising down moves at the beginning of last year. Those start to fall out over the first 6 months of the year, so we will see a pickup. The question then becomes, is it a durable pickup, or is this just a function of statistics, the way that statistics are compiled? I think there is something of a risk, particularly if we see other companies following the Walmart example that we saw yesterday by raising the lowest level of pay by 10% from $10 to $11 and also increasing bonuses, then that should be grist to the mill a little bit for consumer spending, and that would probably see beleaguered retailers, particularly in terms of bricks and mortar retailers, taking the opportunity to try and improve some of their margins, which are very, very wafer thin at the moment.
Okay, let's move on to the ECB signals exit from quantitative easing.
I think that's. I don't even think that's a risk anymore. I think that's a fact. The real question there is, will we see a downward impact on Eurozone consumer price inflation from any strength that we see in the euro as markets go to price in a first ECB rate move, say, by the end of the year? And what impact will that actually have? The other side of the coin, obviously, is what happens with oil prices, and that will be absolutely critical to that, because oil prices have been one of the elements, along with food prices, which have served to depress Eurozone inflation. If the growth continues that we're seeing, and if wages continue to pick up in the Eurozone, then I think there is a material risk that the ECB, having been very, very dovish during the whole of Mr. Draghi's tenure, starts to become rather less accommodative. I wouldn't necessarily call it hawkish, but less accommodative.
How about jump in volatility due to higher inflation?
That's certainly one factor. I think the jump in inflation would also have to precipitate a rise in bond yields, because at the moment bond yields assume that inflation is going to stay very well behaved, in fact very subdued, below target. The key point here is markets are factoring in, probably even in the countries which have got a bit of inflation like the States, only a level of about 1.8, with real yields where they are, which is only about 0.5, 0.7. If we get solid growth and actually inflation turns out around about 2.4%, which would leave real bond yields almost at zero, you're suddenly looking at a situation where you've got this rush for risk because bond yields are so low, but you need bond yields to reprice to factor in that inflation is actually going to be we're not talking about a big inflation push, but it's going to be slightly above target. And at that point, you actually start to look at nominal yields and you say, well, do I need to make such an effort to chase returns in riskier assets like equities, like credit, like high yield debt, like emerging market debt, or can I allocate more of my portfolio to the conservative end of the spectrum, particularly if we get US rates up to 2.5% by the end of the year? Having money on deposit suddenly actually becomes a really viable option, which it hasn't been for the best part of 10 years.
Yep. Okay, how about a Bitcoin crash dents retail investor confidence?
I'm sure there are going to be multiple crashes. Depends on what one defines as a crash. I think you're almost at the situation with a lot of these cryptocurrencies that a crash has to be defined as something which is maybe 75% or more, because 35-40% is in the almost nature of the beast. So I think the point about it's not a huge retail area is not necessarily, it's still not a huge volume area. So it may dent a few people's confidence, but I don't think in the longer run it's going to stop the enthusiasm for cryptocurrencies.
US midterm elections in November.
That's very real. There's no question about that. The way things are shaping up at the moment, It certainly looks like the Republicans are going to lose control of the House, possibly the Senate, debatable. But if you then get into a situation where you've got a president who is fighting against Congress, then some of the optimism about Trump getting things done would seem to be very misplaced, particularly given the record of actually achieving things has not been nearly as decisive as he had hoped it would be, and indeed financial markets had hoped it would be.
Okay, well, let's just wrap up with the last one, because I know there's probably quite a few more. Housing bubble bursts in China.
I think the risk of housing bubbles bursting in any number of places it can't be underestimated, particularly given that we've got a fairly substantial rise in some of the more vulnerable. It's not only China, it's places like Australia, Canada. So there's been a lot of money invested in the housing market during this era of financial repression. If we get to a situation where the fact that a lot of people on lower incomes still can't afford housing, and the fact that people who have been investing in housing start to look at other markets and say, actually, I don't need to allocate quite so much to housing investment, then the risk is a risk of a setback. I think in the case of China, I think the one thing one does need to remember very, very strongly is, yes, there is a speculative element to it, but in the longer run, the authorities aren't going to let house prices fall that far without actually leaning against such a move.